Good afternoon, ladies and gentlemen, and welcome to the CENTRALNIC Group PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I would like to submit the following poll, and I would now like to hand you over to CEO Michael Riedel. Good afternoon, sir.
Thank you very much for the introduction, and thank you very much for everyone who's joining us on this hopefully sunny afternoon, wherever you are. And today we're going to discuss four items. First, the highlights of the first half of this year, 2023. Then a business profile to describe CENTRALNIC to those who are maybe new to the case. Third, our Head of Investor Relations, Martin, who is with me on this call today, will then delve into the financial results. And finally, we will conclude with a chapter on strategy and outlook for the future. And I hope you will enjoy today's presentation. So looking at, starting off with the financial highlights, we've again grown our revenue by high teens margins, or percentages, by 18% to almost $400 million of gross revenue. And our net revenue, which is basically gross revenue reduced by pass-through costs like traffic acquisition cost or registry fees, has also increased by 11% to more than $90 million. And more importantly, due to the rigorous cost management that we are running here at CENTRALNIC, the EBITDA has grown faster than net revenue at actually 16% to almost $45 million in the first half. And given that we're not only managing the cost items between net revenue and the adjusted EBITDA, but also all the cost items between EBITDA and the earnings per share, in combination with the share buyback program that we are currently conducting. And we will give some more detail on that later. So in the combination of these two factors, the EPS has gone up by 34% from around $8.5 cents in the first half 2022 to more than $11 in the first half 2023. And it is only due to this share buyback program that our net debt has gone up, in combination with the earn-out payments that we've done for the excellent acquisitions we've done in the last year, which have performed very well in 2022. But this is not an accident; it is a choice. The leverage levels are very low, and what's maybe even more important than that is, in the annual report, we've laid out a cash flow waterfall model, so how we would allocate our cash flow going forward. And of course, we're doing exactly what we promised there, which is, if conditions allow, we will return money to shareholders, and the conditions absolutely allow to do so. Just looking at the cash flow, which is around $42 million now in the first half of this year, which needs to be seen also in the context that, as you will see on the next couple of slides, we are currently investing part of our current success to build the success of the future. When we now see how the success breaks out between the two operating segments, online marketing and online presence, we see that online marketing has still shown 36% organic growth in the trailing 12 months ending the 30th of June 2023. For those who are new to this presentation, this is our methodology, how we differentiate between organic growth and M&A growth. The navy part of the columns is actually the reported revenue, as you would find it in any kind of public reporting that we've put out, whereas the papaya part is the additional revenue that we would have reported if all today's constituents of the group would have been part of the group for the entire two comparison periods. You can already see that we've slowed down a little bit on M&A, so the papaya part is relatively small compared to the Navy part, and yet we've seen the online marketing segment growing to $623 million of revenue in the 12 months ending the 30th of June this year. And we're also particularly proud at another accomplishment, which is after years in mid-single-digit percentage growth rates, we've instilled new life into our online presence business, which has now, in relative short order, accelerated to 15% organic growth, again, as observed over the 12-month period from the 1st of July 2022 to the 30th of June 2023. And we hope that this makes, that gives us also comfort to those who have invested into the initial business case when we were all domain names, that this business is still alive and kicking and has a fantastic future ahead of itself. And it's not only that we are growing in absolute numbers. Of course, this is the ambition of CENTRALNIC. We always want to be the best. And in both, while there's no perfect comparable ever for any kind of company, there are two companies which we've set ourselves as, which we define as our target. And the one is System One Incorporated in Venice, California, not to be confused with System One Group PLC here in the UK. And as you can tell from the slide, in 2020, our online marketing segment was only doing 42% of their revenue. However, now in the first half of 2023, we are virtually on par with them. And what's important to note here, these figures are already M&A adjusted. So we basically added back the revenue from the acquisitions as if we would have owned these companies already back in 2020. So all this catch up is completely organic. And also in our online presence business, we have a similar pattern. So here we track Tucows Domains, who is at this time the world market leader in domain name wholesaling. And also here we've caught up from 55% of the revenue in 2020 to now 77% of the revenue in the first half of 2023. And you might wonder, how have we done this without the lever of M&A? And the answer is we work very hard on building new leading products and at acquiring strategic partners who help us symbiotically to grow. We help them growing and they help us growing. And the most prominent examples for product innovation in the first half of this year are probably the launch of our French clone of our product review portal, vergleich.org, where we've chosen France as the first market to go into, a strategic choice, given that France is the second largest EU market for Amazon after Germany. And another product innovation that has actually drawn quite a lot of attention from the relevant internet forums is our AI-powered domain search on internet.bs, where rather than giving the typical examples, let me give you an example. If you would now try to register investormeetcompany.com, you would of course see that it has already been taken. And typically, existing software, or let's say market standard software, would have then given recommendations like, why don't you take investormeetcompany24.info? Our new tool would then, for example, come up with new suggestions like connectwithinvestors.com or similar suggestions where you use the full richness of the human language. And it's not only a nice feature, as we will present to you at a later slide in this presentation, it has an actual immediate and notable impact on the success of this product in the market. Then coming to the second vector, which is strategic partnerships. So here we take pride in us having been selected as one in only 2 companies globally that may provide critical domain services to the UK government. And we expect to make further announcements around this partnership when we actually win the first lots of this multi-year procurement contract. And then just in the last couple of weeks, we had like a firework of major strategic partnerships. We were elected as a tier 1 demand partner by Sovereign, one of the leading supply side platforms in online marketing, by Klarna, a leader in buy now, pay later, Booking.com, that many of you might have just used recently to book your vacation, and then also with Shopify, which of course is a name that everyone knows. And why is this important to us? We have the ambition and the aspiration to partner with the best, just like we do with Google, with Microsoft, with Amazon. We also want to add the best in each category to the portfolio of our business partners. And the good thing is that even though we are still a sub $1 billion revenue company, we have absolutely no trouble winning these customers, because we have a reputation to absolutely help them managing towards more growth, and they in return also help us managing towards more growth. I mentioned that we have not done any M&A in the first half of this year. Actually, we now had like an 8-month hiatus, which doesn't mean that we would not look into more M&A. We are just even more selective than in the past. And because in the meantime, the business has been throwing off considerable amounts of cash, we resolved to actually upgrade the share buyback program, which we had first announced on the 15th of May, from 4 million sterling to 34 million sterling, and with an objective to basically use the entire authority that the AGM has given us earlier this year to acquire roughly 10% of our outstanding share capital. And again, this is then fully in line with the cash flow waterfall that we've defined in the annual report. So when CentralNic promises to do something, you can count on CentralNic actually delivering on it. These were the highlights for the first half. We are now coming to the business profile, describing what CentralNic actually does. And we describe CentralNic in relatively abstract terms as online marketing and online presence. However, in total, we have a portfolio of 45 brands. And some of these, like, for example, Tonic, which is currently the single largest revenue contributor of the group. But we still wanted to show to you that there is opportunity from in the platform that we inherited. And this opportunity is basically twofold. The one half is that among these 45 brands, there are still quite a few new brands that are not yet at full potential, which we are now nurturing and growing them into the business, into the best business that they can be. And we will quite likely also go through a process where we might sunset some of these brands. And whereas the first will deliver more growth and a more diversified CentralNic, the second will deliver a more concentrated and less complex CentralNic, or more efficient CentralNic, both of which will then ultimately translate into shareholder value. And if you think that this page reminds you of a checkered flag in a car race, you're right, and it's intentional. And this is because I like to compare CentralNic to a race car. So in car racing, you would need to build the fastest car within the limits set by a regulator like the FIA, and then still make that your driver, your engineers, and your pit stops team are completely working in harmony in order to actually win the race. And this is exactly what we do at CENTRALNIC, building the best systems within the rules defined by ICANN, the IAB, GDPR, or large industry players like Google and Amazon, and making sure that our engineers and sales team and operations people all work hand in hand to deliver success. And you've seen the success on an earlier slide, us catching up at a very fast pace to our competition. And while we've now seen all these 45 brands, we already have this huge set of companies who are already at or very close to market leading positions. So our Optonic platform is, to the best of our knowledge, the largest Google AFD-based media buying platform. AFD stands for AdSense for Domains, where it also shows that the domains, even though we now expanded to online marketing, have always been the DNA of CENTRALNIC. Parking Crew, a globally leading domain parking platform. Vergleich.org, the #1 product review portal in Germany-speaking Europe. CENTRALNIC Reseller, the second largest domain name distribution network on this planet. Volume Tracker, which many consider the leading cloud-based analytics software for e-commerce affiliates. ZeroPark, our emerging commerce media platform. That's the company that signed up all these people like Booking.com, Klarna, and others. And last but not least, the oldest brand in the portfolio, CENTRALNIC Registry, established 1996, and still the world market leader in registries services for new top-level domains. And so there's a huge set of market-leading companies, and while all of them do something slightly different, one thing that they have in common is they create value by connecting otherwise unconnected parties, whether it's social media with search engines or domain registries with domain registrars. And over this portfolio of brands, we've built this vibrant and symbiotic ecosystem where we are connecting a vast array of supply-side partners with a very substantial set of demand-side partners, thereby creating value. Here again, you see the pro forma figures from the second slide. $623 million of trailing 12 months pro forma revenue in online marketing, 171 in online presence, together not very far from $800 million already in trailing revenue for the 12 months ending on the 30th of June 2023. While this looks complex, in the end, it is not really complex. And you can describe both businesses with only two metrics each, which is a volume driver and a price driver. And the volume driver for online marketing business is visitor sessions. So how many people embark on the consumer journeys that we offer? And this number has increased from 3.5 billion in the 12 months ending on the 30th of June 2022 to 5.3 billion in the 12 months ending the 30th of June 2023. That's a 49% increase. And despite all the talk about online marketing, we've also been able to keep our revenue per thousand, so that's basically the value that we extract from each customer journey, constant at $100 per 1,000 journeys. And this is also based to our constant optimization through machine learning that we can basically grow faster than the market, which, as you will know, is currently in decline in terms of click prices for the market as a whole. And for online presence, it is not very different. Here, the metric is total domain years processed, which increased from 12 million to 12.9 million. Again, same reference periods, same 7% increase. And we were also able to increase the revenue per processed domain year from $9.83 to $10.46, a 6% increase. And what plays into here is not only our pricing power because of our reputation and the quality of our service, but also a gradual shift that more and more demand goes into so-called country code top-level domains, like for the big countries, UK, DE, FR, or even exotic ones like .ai being the island of Anguilla, or .io being the British Indian Ocean territories. And this is exactly where we have our competitive edge. And this is why we see a very bright future for the online presence business as well. And the right-hand side is meant for as a reference point for retail investors who might not have access to broker research to just see some key financial metrics. Having mentioned financial metrics, we now come to the financial results, and I will hand over to Martin, who will run you through the next couple of slides. Thank you, Martin.
Thank you, Michael. So in this section, I'm going to delve into a little more detail on the financial highlights that Michael referenced earlier. So on the first slide, we look into the income statement in a little more detail. So as highlighted by Michael, we have had a very healthy top-level revenue growth in H1 2023. So it's grown at the rate of 18% over the same period last year, reaching nearly $400 million. At the same time, we've managed to continue expanding our gross profit or net revenue, which has experienced an 11% growth in the same period, reaching $91 million in H1 2023. As highlighted, we are growing our gross profit, but also keeping a close eye on the operating expenses. And as a result, we've managed to, in the same period, to grow our adjusted EBITDA at a rate of 16%, so exceeding the net revenue growth. And the adjusted EBITDA for H1 2023 is now reaching levels of around $45 million for the half year. I will address the items below EBITDA in subsequent slides, so I'll move on now to the balance sheet. The one area I wanted to highlight here is the obvious increase in net debt in H1 2023 over the number we reported at the end of 2022. And as mentioned by Michael, this is largely due to conscious decisions by the company to return value to shareholders. So a large item on the right-hand side is the share buyback program, where in the course of H1 2023, CENTRALNIC has returned $13.6 million to investors via the share buyback. We've also paid out our maiden dividend at the beginning of the year, contributing $3.6 million to the net debt. And as highlighted, we've also had paid out a deferred contingent consideration for a very successful acquisition we did early in 2022 to the tune of $15.2 million. And to highlight, all that cash was generated by the operations of VGL, so the business that we acquired. Moving on to the cash conversion slide, our cash conversion remains high at 94%, largely in line with previous historic periods. And as promised, if we look into more details under the EBITDA, we'll have noticed that, first of all, we've got very good evidence of operating leverage. So the net revenue gross profit has grown by $9 million period on period, but the expenses helping to generate that growth have only grown by 3 million. So thanks to the operating leverage, we're able to contribute 6 million more to the period EBITDA in first half of 2023. This is the same period last year. As Michael mentioned, we haven't done any M&A in the last 8 months. However, the impact of the large M&A program at the beginning of 2022 continues to impact the waterfall down to operating profit, where the amortization of intangible assets charge linked to the large acquisition of VGL and others in previous periods contributes or impacts the operating profit result. We largely, thanks to the increasing interest rates, we've been able to take advantage of our large cash holdings to generate some interest income that partially offsets the finance cost charge. As a result, we've been continuing to generate profits despite the impact of large non-cash items. With that, I'm going to hand back over to Michael to cover strategy and outlook. Thank you.
Thank you, Martin. So the key question is, what do we do so that we continue to grow and become more profitable quarter after quarter? And our vision here is to operate this virtuous circle, which starts with organic growth, where we win new customers, we grow existing customers, cross-sell our services across the different businesses, and launch new products and contract with new suppliers. And you've seen quite a few examples of that on the slides in this presentation. And this organic growth, combined with our rigorous cost management, then leads to operating leverage. And the evidence for this is the always increasing ratio between EBITDA and gross profit. This is what we believe is the more relevant EBITDA margin. And here we are not very far from 50%. And this operating leverage then in return allows us to obtain competitive cost of capital. We had a major crystallization event in the last year when we refinanced our bonds through a bank syndicate, where we reduced our interest margin by roughly 60%, from 7% above market to 2.75% above market. And given that we've already achieved this on the cost of debt side, we are now focusing this year on creating or shaping the balance sheet towards more efficiency. Hashtag share buyback, we already spoke about it. And this competitive cost of capital in return then allows us to do focused bolt-on M&A, and each acquisition that we have done and that we will do will always then help us creating new adjacencies or gain new strategic capabilities, which then again add fuel on the organic growth quadrant of this graph, and then it becomes a circle. One thing that will help us in this is artificial intelligence. And probably in 2023, there's no investor presentation without an AI slide in it. However, I should mention that all material businesses of CENTRALNIC have always been built around AI, mostly in the form of machine learning. This has always been at the core of every product that we've built. And but for us, AI does not only mean applying technology. It's really about reimagining CENTRALNIC as a market leader. And we've demonstrated to you how precious we are about market leadership in a data-driven era. And in order to get there, our AI strategy is basically built on 3 pillars: enhancing our AI capacity, accelerating the AI impact on our business, and then scaling our AI advantage for above market growth. And because of that, just in the last 12 months, we've piloted and launched dozens of AI-based projects. And of course, these could not fit the slide, which is already quite text-heavy, I will admit. But for example, the AI domain spinner that we presented earlier as one of the examples of innovation in this year is a first of, and it has increased the conversion rates on our retail portal internet.bs by a relative 20%. We've also been strategically integrating AI into the product reviews on VGL. That's a company that operates Vergleich.org, which now allows us to go into niches which would otherwise have been too small to justify the cost for manual content creation, or we can more quickly create new variants of our content to bring new white label partners, adding more traffic into our network. And also we're using AI internally. So we basically aggregated a huge data pool among all the different about all the different online presence assets that we operate into our HubSpot CRM system, which is now driving massively positive impulses to our sales teams, and which has also been an enabler of the much accelerated growth in online presence that we presented to you before. And we also take pride in always trying out the latest thing. So we were one of the first companies who've been granted access to the Google Vertex API. So we're not only taking the for free chat GPT as our benchmark. And in order to further accelerate this, in 2024 we plan to create an innovation hub, which will help us to more quickly churn out new products, to further diversify our revenue streams. And we will introduce an internal AI academy where we will teach all our employees, not only a select set of engineers, how to make the best use of AI. And why are we doing this? When I think back like a quarter century or so, when I had my first internship at Deutsche Bank, they were actually paying for mouse training, because at that time the average employee would not know how to use a computer mouse. So they had to teach them. And we believe that this new generative AI is just at least an as important and fundamental innovation. And we want that every of our employees is the best at it, and that no one is left behind, so that the team can then deliver the future growth that you all expect. Then while this is to be seen aspirational, this is a vision that we are following, and many of the things that we are going to do will feed into this vision. And McKinsey has coined a term, social commerce, which in the end, if I just rephrase it, means selling stuff to people on social media. And why this sounds trivial, it is really hard, and it is like the holy grail that large companies like Meta and TikTok, well, the companies of course called ByteDance, or Amazon are searching for. Meta and TikTok have already, since a long time ago, have started marketplaces. Now TikTok Shop is all the hype. Amazon has just launched its fifth initiative to build a major social media platform, Inspire. And here we understand from their public market communication, the idea is to try to be simultaneously the best social media platform and the best e-commerce platform. And while they may succeed at it, we still believe that there is space for our approach of connection, basically connecting the best social media platform with the best e-commerce platform. And why are we particularly well positioned to get there? Because today we have two businesses. The first, Tonic, is able to take social media users, attract them, understand them, pre-qualify them, and then run them into search ad campaigns of any kind of advertiser in many hundred verticals. And we make money even though we only get a share in the click price. Then we have a second business, VGL, where we can actually pay the full Google click price to advertise on a search engine. And we still make money because we are so excellent at converting this traffic into actual e-commerce transaction that we make more money from Amazon and other e-commerce partner commissions than what we pay for the search ads. And now just think combining these two skills into like one superpower, which is like this aspiration that you see in the left bottom corner. So this is the direction in which we want to head. Of course, the names that you see here are only illustrative. We will include many more different platforms on both sides of the equation, but this is where CENTRALNIC wants to be in the midterm future. Basically, cracking the formula of how to convert low intent social media traffic into actual e-commerce transactions. Coming from the midterm vision to the status quo, again, as a recap, CENTRALNIC operates in two highly attractive segments: high growth digital advertising, what we call the online marketing segment, and domain management solutions, what we call the online presence segment. Again, online marketing is about creating privacy safe, AI generated consumer journeys that convert general interest media users into high conviction consumers. And online presence is a critical constituent of the global online presence and productivity tool ecosystem, where we serve as the primary distribution channel for a wide range of digital products, most importantly, exotic domain names, which are selling very, very well. And therefore, our outlook is the directors are confident in the group strategic investment in innovation, integration, and global expansion, and therefore anticipate that we will perform at least in line with current market expectations in this year. And because of this expectation, combined with high cash reserves and a committed credit facility, the company is fully funded to execute on its strategy to simultaneously invest into its future and also returning cash to its shareholders. Then a last concluding remark. The market has asked us for a full 3 years, and we've listened, and we've now finally arranged for the company's second Capital Market Day, which we are going to hold on Monday, the 4th of September at 9:30 a.m. at the London Stock Exchange. And we are looking forward to it. At this occasion, you will not only see me, who you always see on screen, but you will also be able to meet and mingle with the key members who run the actual operational divisions and extract all the value that you deserve. Thank you all, and I now end this presentation and would move on to the Q&A section.
Michael, Martin, that's great. And thank you very much indeed for your presentation this afternoon. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the top right-hand corner of your screen. But just while the team take a few moments to review those questions that were submitted already, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Martin, Michael, we did receive a number of pre-submitted questions ahead of today's event, and as you can see there in the Q&A tab, we've also received a number of questions throughout your presentation this afternoon as well. So firstly, thank you to all of those on the call for taking the time to submit their questions. And Michael, Martin, if I could just hand back to you to respond to those where it's appropriate to do so, and then I'll pick up from you at the end. Thank you.
Right. Okay. And I'll just go through the questions just as I see them on my screen. Is there any revenue from Microsoft in Q2? If not, when do you expect the first revenues from Microsoft? So in Q2, there were only marginal revenues from basically a test environment in which we've implemented the feed. And now in Q3, we're actually testing it to remove any child diseases. We would expect the first notable impact in Q4. And this is, of course, very critical to us, given that Q4 is the quarter for any kind of online marketing-driven business. So don't expect too much revenue in Q3, but then in Q4, we should then finally see notable impact. What are you going to do with the shares of the buyback? Cancel, keep in treasury, use them to buy other companies. So at this stage, the board has not resolved on it, and would only do so probably after year end. So for now, we are keeping them in treasury, and then determine on the further use of them. Currently, our main focus is to deliver on the program and then see what we do with the shares. However, once the share is bought, it doesn't participate in dividends. It has no voting rights anymore. So in the end, technically, it's not a very big difference whether they are cancelled or in treasury. Are you happy with how internationalization is going in France? Do you have in mind entering new countries or languages in the near future? Yes, we are happy, and but then again, Vergleich.org it also took them 7 years from starting to the point where we acquired them, and so also here this new plant will need to be nurtured for some time to really develop potential. But then, of course, the French economy is very strong. 60 million inhabitants, healthy economy and stock market. 4 out of the 5 most valuable companies in Europe are actually French. So we are very happy with the choice of the country, and it now took us roughly 15 months after the acquisition of VGL to go into first abroad market. Going forward, we anticipate a higher cadence, but the next market entry would only be in the next calendar year. And for confidential reasons, we will not mention which market it will be. But following our logic, starting with the largest market of Amazon in Europe being Germany, and then going to the second largest EU market. The second largest European market is the UK, of course. You see the pattern. So yes, we will continue with this. Then next question: you have paid in this Q2 the deferred contingent consideration. Will there be more this year or in 2024? In 2023, I think there would at best be very marginal amounts from Illo Tempo acquisitions from many years ago. So I would believe nothing. That's on top of my head. And in 2024, too early to say. We really need to see how the year ends. Given that Q4 is of course very critical component. So, but we actually build provisions into our forecasts for our assumptions on future deferred consideration. Fifth, what is the medium-term objective of adjusted EBITDA to net revenue ratio around 60%? I should say 60% is then could actually be an aspirational target. Now we are still in the very high 40s. Next step is making the 50 and then cracking the 50. But yes, 60% is a number that is not entirely unrealistic, and but you should also not expect this in 2024 or 25. But on a longer horizon, yes, we believe this number would be achievable. Next question: what further plans do you have to accelerate growth overseas? Would you consider acquisitions? So growth overseas, that's actually an interesting one. Even though we are headquartered in the UK and have huge populations of staff in Germany and Poland, our largest market is actually the United States. In online marketing, it is more than 50% of the revenue. Over the entire group, it is somewhere in the low 40%. So yes, most of the revenue is already overseas from a UK perspective, and thereafter is pretty correlated to the global distribution of GDP. So you would then see the UK, Germany, France, Japan as major markets. I think the only major economy where we are materially underrepresented at this stage is China, given that here some of our main trading partners have no foothold, and Russia, where we currently choose not to trade. But yes, absolutely, we want to sell as much as we can in every country, and if an acquisition helps us doing that, we will of course consider it. Next question: how many acquisitions would you expect to make in the next 12 to 24 months? What attributes would potential acquisitions have? So we now had 2 quarters of 0, whereas before we had like 4 years of at least 1 acquisition per quarter. I would expect that we will find ourselves somewhere in the middle. Again, doing M&A, but maybe not returning to the same pace. And as we put on this one slide, we specifically inserted the word bolt-on acquisitions. You should expect that every acquisition fits so logically into our value chain that everyone will understand why we're doing it and how it fits into our business. So don't expect any surprises to buy something completely uncorrelated to our current business setup. Then what is your current thinking on either moving to main UK market or US listing? So one of the reasons why many years ago we already chose to accelerate our reporting to 4 quarter reports, and we've also invested material work in accelerating the reporting cycle, is to at least strategically have the option to move to the US. However, we feel that at this stage it might still be a too early consideration, given that while we're now part of the AIM 100 index in the United States, we would maybe not even be a small cap, but rather a micro cap. And this is maybe we don't believe that this step is due just now, but at least from a process perspective, we are in shooting range. And the UK market, let's see. We will probably first wait until all the market reforms are in final form to really understand what the differences will be between a market and the main market. You've also seen the announcement or you may have seen the announcement that the government is pushing pension funds to invest more into unlisted equities. AIM companies still count as unlisted in that definition, to the best of our knowledge, whereas main market would not. So in this change, in this time of pivotal change of markets and policy, we would probably give ourselves at least 12 to 24 months to first observe the situation and then make a call on this question. Next question, 3 questions in one. Okay. How much deferred consideration payment is left based on current performance of acquired firms? How much do you forecast over the medium term? So I should say, first of all, it depends on the performance of some assets over the rest of this year. Even in the best case scenario, just the way that the contracts work, probably these payments will be less than they have been now in this year. And after 24, unless we would do a new material acquisition, they are only very, very marginal amounts. So basically it's only this year and to some degree next year, and then we've basically cleared out the deferred consideration of the historic acquisitions. There's more detail on the exact figures in the notes of our H1 report. Second question, online presence and online marketing. The COGS as a percent of revenue have increased by 2.8 and 1.2% respectively. And here the story is very similar to what we've always been saying in both segments, online marketing and online presence. the sub products that have the lowest gross margins are also those who have the highest growth. So in online presence, our domain wholesale business is showing the most growth, and is also the one that has the lowest gross margins out of the different businesses that together constitute online presence. In online marketing, Tonic, which is our lowest margin product in the online marketing, on the online marketing side of the business, is also the fastest growing business, which makes that in each segment, the average gross margin asymptotically aligns with the gross margin of the largest and fastest growing product, but it's not representative of a deterioration of market conditions. And we think that we are now, Tonic and Centric Reseller are so large in each division that we believe that this reshuffling process is slowly finding its end, and we should then see margins not very different from where they are today going forward. Then, as guided in FY22 annual report, as you're still expecting adjusted EBITDA net revenue to be 48%, we already mentioned that, yes. So I think the long-term target would even be much higher than the 50 to 52% that are indicated here, but 50 to 52% could be a good interim target that we will aim for in 24 and 25. When potential investors tell you they will not invest in CENTRALNIC, what are typical reasons? Well, they never tell us. They just go silent. However, fun apart, just reading the broker reports, the most frequently quoted reason is great story, but we currently don't have any money to invest. So I think the government is very wise, launching initiatives that actually instill new life in the UK equity market. And the initiative that has now been taken with the UK pension funds is probably a very good attempt to go there. It's literally the main reason that we hear, sorry, too many redemptions, too little fund inflow, we can't act. And hopefully market condition will change that, or policy. Next one. Thanks for the good presentation and solid half year. Clearly, Tonic is doing quite well, as you've mentioned. Can you confirm how VGL acquisition is doing? How is Mayor rollout project going? So strategically, VGL is completely on track. We're making a lot of improvements here. And then if you just look at the business mix, e-commerce affiliate businesses are probably the businesses that in 2023 struggle more than other businesses. Just when we look at the largest UK-based e-commerce affiliate business, I'm not going to spell out the name. They've just been going through a few profit warnings. But as you can tell from our figures, we're still on a growth pattern, and as you've also seen, VGL is a key component of our future strategy for social commerce. So it's an asset that we are clearly committed to, and that will return its purchase price back many times over. Can you provide more color on the phasing of your 36% organic growth over the TTM period? Specifically, what was the organic growth rate if you look at only the last 3 months of the TTM period compared to the corresponding 3-month period of the previous year? Well, we could probably do that math. However, we always look at 12-month periods to avoid that seasonality or certain events distort this math. But if you just look at the reported numbers, so which you can easily derive from the reports in the market. We now had 18% revenue growth in the first half. Martin remind me in the first quarter it was 17%, which means in the second quarter it was more, let's say 19% reported growth. The largest acquisition last year was VGL in the first quarter. So the second quarter is, except smaller acquisitions, completely comparable. So not having the math at hand, I would make a qualified guess. Probably it would look like 15%, which is probably still best in market in this sector, and not reflective of our long-term growth potential. Have you noticed a re-acceleration of revenue since the end of the half year? Is the Bing relationship contributing revenues yet? I think I should not comment too much on numbers that are not in the public domain, but I would go so far to state that I'm very comfortable with the current status of the market, and we already answered the question on the Bing relationship. How big is total market opportunity for online marketing and online presence? Triggered by you closing on largest competitors, how much of the market is there left to take? So yes, we are closing into the largest competitors, and I think we have historically we have shown a $600 billion at total addressable market for online presence. For online marketing, and that was probably a mistake, because at least with our current business setup, we will not be able to address the full $600 billion of this market. However, we address the market for search ad syndication, which is and you can see that in the Google quarterly reports. They have this line, total traffic acquisition cost, which is a low double-digit billion amount each quarter. This is probably the more realistic addressable market, out of which we now take at least a measurable market share, but of roughly 1%. But why not grow it to 2%? Everyone needs more traffic. Google's advertisers need more traffic. Google is happy because they make money in the process, and the social media platforms where we buy the traffic are also happy because we are then one of the most attractive advertisers on them. So we think from an addressable market perspective, there's still notable runway for our business. And then, conscious of time, moving on to the next one. Can you explain your view on CENTRALNIC return on equity? The balance sheet is weak with high debt. Well, I think that's a bit judgmental compared to our peers. Our debt is probably the lowest of any of our peers. Return on equity has many definitions in accounting terms. We mostly look at the cash flow yield divided by our market cap, which is currently somewhere around 12% or so. And whereas on after post-tax, whereas on our on our debt, we pay some 7.x% of interest, which is mostly tax deductible. So after tax, we pay sub 6%. And when you have two opportunities to either invest at 12% or at 6%, what do? At this stage, we've decided to take the 12% bet, which is buying back shares, and which we've committed to this, and will of course also deliver as we promised. What percentage of revenue does Tonic contribute of gross revenue? It is a bit more than half. On net revenue, it is less than half. We will see whether we give a more detailed breakout of this in a future investor presentation. Next, I should mention here, while many people of course mention the connection with Google, but for us, Google is a multiplier. in the end, we serve hundreds of verticals, and the largest concentration that we have in advertisers are US dentists, which make up maybe in some months 1.5% of the revenue, and that's basically when we look at the matrix between verticals and geographies, already the largest concentration risk here. So we are very comfortable with the setup of Tonic. Next one, congratulations on the interim. Strong top line performance and the presence of OPEX. Only slight negative, which I saw, was gross margins. We've addressed that, so that's more a reshuffling of the product mix within the segments. Well, have they now bottomed out? Not yet fully, because we still see the trends that Tonic and Central Reseller grow faster than the other products in the division, but we're very close to it. Then wouldn't it be better to reduce net debt rather than doing share buybacks? We've just done the math on the back of an envelope. Basically, buying back shares delivers 2 times the return on our money than paying back the debt. But we will, of course, take this into consideration for the time after the expiry of our current share buyback program. So then on the cash and the debt, can we not offset the two permanently, not just in presentations? Talking about the gross debt that we hold and the gross cash and the gross debt that we hold. Yes, to some degree we could do it. However, it's not, while interest is now high, you can now also get interest on your deposits, actually on US dollar accounts for the amounts that we have at disposal. You're not far from 5% interest income. Yes, there is a small margin, and we will work towards reducing it. But to some degree, we're also keeping ourselves a bit of flexibility if, for example, in very interesting acquisition opportunity would come along that requires immediate action. What do you see as a potential threat in the online marketing? Could Google implement changes which impact your business model? What is your customer concentration? Thank you. Well, Google constantly implements changes to the business model, and our attitude is that we embrace them because Google is doing them not to torture us. They're doing it to build a healthy ecosystem where advertisers can commit millions of dollars of advertising spend, knowing that all of it will go to good use and they will not be spammed. So this is why we embrace these rules and basically work with them hand in hand to implement these rules. So yes, they change the rules all the time, but we see this as a positive. And on the customer concentration, we just mentioned the largest customer / geography concentration is on US dentists, with only a bit more than 1% of revenue concentration. Then if you succeed with your aspiration of having CENTRALNIC as the single link between social media platforms and Amazon for driving social media user transactions, is squeezing out Google, what would that mean for margins, growth, and net revenues, etc.? So first of all, repeating what I already said, the names on that page were only illustrative. We would want to work with many more partners on both sides of the equation. And we also don't necessarily see that we will squeeze Google out. To some degree, there might be some cannibalization, but we expect that this will be mostly incremental on top of the business that we do today. And in terms of margins, growth, and net revenues, so it will definitely be positive for gross revenue. And then the margins, we will need to see how this specific sub-segment of the online advertising market works. But we would expect it to be at least on the level that we currently experience on the level of Tonic or better. So it should, all other things being equal, be also slightly accretive to margins. But again, very, very early days to judge. Then, are you likely to do any M&A this year? Are assets getting cheaper to buy? And as we mentioned, we've not given up on M&A. We now had the longest hiatus in a very long time on M&A. I would say it is more likely than not that we would do some M&A this year. But then again, it will be in line with what we just said. Acquisitions notably smaller than, for example, VGL last year, and always with an immediate fit where everyone would understand how it fits into the business. And yes, we see that some sellers are now more motivated than a year ago, and this is also what feeds our confidence in us being able to deliver on the accretive acquisitions that we promised to the market too. Are you utilizing open source AI models for internal AI model like those found on huggingface.com? Are you relying on external AI providers? This depends. For some sensitive data applications, we would use our own internal models, and for some less critical tasks or more generic tasks, we would rely on third party software. In the end, it's like on a construction site. For each task, you use the right tool. Sometimes it's a hammer, sometimes it's a saw, and the same applies for our use of AI. So yes, why is Billy not doing the presentation? He unfortunately had some issues which prevent him from participating today. But don't worry, he's at good health, and at the next call, he will again be around. Regarding the impressive reductions in OPEX which you made, should we view the Q2 OPEX as the run rate quarterly figure going forwards, or is there any reason that it was unusually low or might increase materially in the near term? I think it's a good indicator of the near term run rate, and of course we will implement further improvements to our cost base wherever we see any potential for it. Why not reduce debt rather than cash? We mentioned this several times, but we see this is on top of the mind of many, and we will consider that in future decisions. Will there be any costs associated with the AI Innovation Hub and AI Academy? And if so, are they included in your financial forecast? Yes, there are some costs, and they are only partially included in the financial forecast. Of course, we always have, every good company would have a budget for training their staff. We will just now use it differently, more in AI. So I would say that component is clearly in there. And then the Innovation Hub, we will probably also feed it mostly from internal top talents that we have internally. However, if we would then have a great, really big project, then we would, and of course, inform the market if it would have a material impact on our future profit forecasts. But at this stage, there's nothing on the radar that would be so big that we can't cover it with the budgets that we discussed with the brokers doing the analysts doing their notes. What is behind the 18.5 million amortization and impairment of intangible assets? So as Martin mentioned, after each acquisition, we must allocate a part of the purchase price to things like their trademarks, assembled workforce, customer relationships, and other things, and then amortize it. It's a rule under IFRS. Whether it's a good rule is in the eye of the beholder. The most important thing here is this is basically purely technical amortization of money that has already been spent, and other than depreciation on tangible assets, where you might ultimately at the end of the lifetime of the asset need to replace it and would then have replacement capital expenditure. Here, this is never going to happen. We never have to buy the trademark of Tonic again. We never have to buy the technology of Vergleich.org again. We own it perpetually. This is why this is, with all due respect for the committees who designed these rules, pretty much an accounting artifact, and is not indicative of any cash flow in this period or a future period. Then congratulations to your team and good results reached so far. Thank you, appreciate it. And average day sales out 43, correct. That sounds about right, but our trade receivables component also has a few oddities in there for don't strike the oddities. There are several components going into these factors, and for someone wanting to build a model, I suggest to reach out to the finance team, who can then help you to sort out the exact figure and how to look at it. And so thank you for that question, Gregor. And that takes us to the end of the questions, which were plentiful. Thank you for the very high level of engagement here. And I know we've overrun for 10 minutes. Thank you for your patience, giving me the time to answer all your questions. And well, I hope you liked what you saw today, and it instilled additional confidence in the future of CENTRALNIC. And hope to see you soon on a future call. Thank you all.
Michael, Martin, that's great. And thank you once again for updating investors this afternoon. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This won't take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of CentralNic Group PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.